Hello, good evening. I hope that you are fine. Um, I'd like to send you this video on introduction to group accounts. I think last time when we met, we stopped on interpretation of financial statements. And there's a couple of things that needs to be done, but I think that we'll be on the safe side if we can start with group accounts. So the standards that we want to concern ourselves with include IFRS 10, which deals with consolidated statement of financial statements. Then there is IFRS 3, which deals with goodwill. And then you have IAS 28, which deals with associates. This is just an introduction to the all-important topic of group accounts. After the theory discussion, we are going to jump straight into question practice. Let us look at the concept of group accounting. If one company P owns more than 50% of ordinary shares of another S, then we can conclude that P has got control over S. Now, if P has got control over S, we are reminded of the definition of an asset under financial reporting. An asset is defined as a present resource that is controlled by an entity as a result of past events from which we expect to derive future economic benefits. I think that it is a very good thought to think that the subsidiary is an asset of parent. On the second point, you should be able to see that P is in effect able to manage S as if it were merely a department of P rather than a separate entity. And that takes us back to the theory of substance over form. What we're saying is accountants must treat business transactions in accordance with their commercial reality rather than their legal form. The commercial reality of a business transaction is more truthful, tends to produce or to give a realistic or reliable picture compared to the legal form. Now, that said, group accounts seeks to combine the financial statements of two or more entities, which of course should be under what we call a related party relationship. P and S financial statements are combined so that we have financial statements for a single entity. In strict legal terms, P and S remain distinct, but in economic substance, they should be regarded as a single economic unit. What is the purpose of group accounts? That's a good question. Number one, group accounts present financial information about a parent's undertaking and its subsidiaries undertaking as a single economic unit. Group accounts show the economic resources controlled by the group. Group accounts show the obligations of the group. And then finally, group accounts show the results of the group. You can read that portion at your own time. I think I touched that one. Let me hasten and go to the key terms that we need to familiarize ourselves with under this very important topic. Number one, parent. Parent is an entity that controls one or more entities. In this case, these entities that are under the control of parent are referred to as subsidiaries. A subsidiary is an entity that is controlled by another entity known as the parent. Now, in our discussion, the word control is crucial, just like the way the word control is crucial under the definition of an asset. Under group accounts, an investor controls an investee when the investor is exposed or has rights to variable returns, which in most cases represent dividends, from its involvement with the investee, and has the ability to affect those returns through power over the investee. Now we're going to respect one theory in our discussion. The theory we're going to respect is that control is assumed to have been taken or achieved by parent when parent has got 50% or more of shares in the investee. In this case, the investee is a subsidiary. Treatment in group accounts is done on what we call full consolidation basis, meaning that all 100% of the figures of S and 100% of the figures of parent are combined in such a way that we have financial statements that depict parent and subsidiary as a single economic unit. Components of control include power over the investee. When we say components of control, we mean parent is assumed to have control over the subsidiary when parent has got power over the investee. When parent has got exposure or rights to variable returns from its involvement with the investee. When parent has got the ability to use its power over the investee to affect the amount of investors' returns. The word associate is also very important to appreciate in our discussion. An associate is an entity over which another entity has significant influence. In this case, significant influence is the power to participate in the financial and operating policy decisions of an economic activity, but does not constitute control. Significant influence is assumed to have been achieved by the investor when the investor has got 20% to 49% of shares in an investee. Treatment in group accounts for all associates is done on what we call equity accounting basis. We shall discuss this again in the near future. Equity accounting involves recognizing an associate initially at cost, then making adjustment for either profit or losses that pertain to the associate. IFRS consolidated financial statements requires the parent company to prepare consolidated financial statements, but we have what we call exemptions in the following cases. Number one, parent is a wholly owned or partially owned subsidiary and owners do not object to it not preparing consolidated financial statements. If that is the case, then there's no need for the parent to prepare group accounts. Number two, if the company is not has got no securities that are publicly traded. And number three, if the company is not in the process of issuing securities on stock exchange markets, then there is no need to prepare group accounts. And then finally, we have the ultimate or immediate parent publishes consolidated financial statements in accordance with IFRS. Now, there's some reasons why some companies may not prepare group accounts, and these are highly discouraged by the standard. We are not supposed to avoid preparing group accounts because we feel that the subsidiary is not performing well. We're not supposed to avoid preparing group accounts because we feel that the subsidiary has got a weak balance sheet. We're not supposed to avoid preparing group accounts because we feel that the subsidiary's core business is not the same as that of the parent. These reasons are not permitted according to IFRS. Exclusion of subsidiaries where control is intended to be temporary has been removed, because now we have a standard IFRS 5 which deals with non-current assets held for sale and discontinued operations, which relates to the performance of the entity that is about to be shut down. Where subsidiaries of different reporting dates, consolidation should still be done unless the difference in reporting date between the parent and the subsidiary exceeds 3 months. Consolidated financial statements must be prepared using same accounting policies. Remember that consistency is very crucial for comparisons. In parent's own financial statements, the investment in the subsidiary should be treated as a financial asset in accordance with IFRS 9, financial instruments. I want to end here for now. Thank you very much for taking time to listen to the lecture. So the next thing that we're going to do is to deal with a question.